this chapter, we're going to be covering bad debts and accounts receivable. So the first thing we need to think about is what exactly is an accounts receivable. What we're going to find out is that this is an asset representing the fact that we've sold a customer either a product or we've provided a service to them and they didn't pay cash right then and there. Instead, they're going to owe us money in the future. We've sold something on credit. So in order to have a credit sale, we have to keep track of what that customer's account balance is. So we have to maintain a separate accounts receivable for each and every customer in order, again, to track their payments, their purchases, what their overall balance is. And with each customer, we have to recognize the fact that certain individuals may simply not pay. Maybe they aren't willing to pay. Maybe they're unable to pay. For whatever reason, some customers will not pay all of their balance. So we have to account for bad debts. So just as a simple example on how we set up this sale on account or sale on credit, same term, when you hear on account or on credit, we're talking about they haven't paid cash right then and there. So on July 16th, Barton Company sells $950 of merchandise on credit to Webster Company and $1,000 of merchandise on account to Matrix Incorporated. So we start off, first of all, with a debit to the accounts receivable for the $950 to Webster and a credit to sales. And then notice we have the same basic entry, only we're debiting the Matrix accounts receivable for the $1,000 sale to them. So what we're basically saying here is we have to keep track of each customer's accounts receivable. We have an accounts receivable subsidiary ledger, which will show each individual customer. So it shows their balance. And then we have an overall schedule of the accounts receivable to give us the total balance. So we have these subsidiary ledgers, these subsidiary accounts for each individual, but we're also going to have a master general account for accounts receivable that gives us the total of everybody. And that's exactly what we're seeing here. The master account for accounts receivable shows us we have a $1950 balance in total. But the problem is that doesn't do us much good if we don't know who the customers are that owe us the money. We need to track each individual customer so we can bill them properly. So now we have a collection. Barton Company collects $500 from Webster and $800 from Matrix on account. So those weren't the total payments, but we've collected some amount that they owed us. So we debit cash for the cash receipt. We credit accounts receivable to reduce their specific accounts receivable because they no longer owe us this $500. They've already paid that amount. So in what we have here for the subsidiary ledgers, we're crediting each of their accounts, and we have a new balance for each account, which we bring over to the schedule of accounts receivable. Now we only have a $650 total balance, and it's going to show up like that in the master accounts receivable ledger as well, or the master accounts receivable account in the general ledger. So that's the basics of an accounts receivable, just a normal account sale or credit sale and then a payment. Now we're going to talk about something a little bit different. It's important to distinguish or differentiate between accounts receivables and credit cards. Most retailers that you and I might go to, they certainly allow us to use credit cards, and maybe they even have a credit card with their name on it, like a Target card. If you go to Target, you may have one of their Target cards. That's not the same as an accounts receivable. Accounts receivables are generally set up between two companies in most cases. They have a relationship. They've done business with each other before. So if Company A buys something from Company B is probably going to go ahead and ship it even though they haven't received payment yet, and they're going to send them an invoice for that amount. That's basically an accounts receivable. If you and I were to go into Walmart and say, hey, I'd like to set up an accounts receivable, they wouldn't be able to do that. That's not something that's normally done for end users, individual customers. But again, we do have the credit card option. So the advantage of this over and above just a normal accounts receivable setup is that the customer's credit or the risk is evaluated by the credit card issuer, by the bank. So the company doesn't have to worry about evaluating their credit. That's all done by the bank. Sales increase by providing purchase options to the customer. Now, the same could be said about an accounts receivable. The fact that you allow sales on credit, that's allowing more flexibility. That generally means you're going to have more sales. But of course, you're taking on more risk that some of that's not going to be collected as well. The risks of extending credit are transferred to the credit card issuer, so you don't have to worry about bad debts with a credit card sale. That's not your responsibility. That's not your risk. The bank takes that risk on. Whoever the credit card issuer was, they take on that risk. And the biggest benefit is that cash collections are quicker. What I mean by this is that with many credit card arrangements, if you accept a credit card for an account and you swipe it through, you get the receipt, a lot of times that company, that store is going to take that credit card receipt, they're going to deposit it in their bank overnight, and it's just like if the customer had written them a check or a money order, it's generally available for them in their account the next day. There are some that, and we'll see here, where the credit card company generally pays maybe once or twice a month to those stores. So we'd set up an accounts receivable, but it would be with the bank, the credit card company, not the individual customer. So in any case, cash collections are quicker. The company gets their cash more quickly. They don't have to wait 30, 45 days in most cases. Sometimes it's as quick as overnight. So that's exactly what we're talking about here. Number one, with bank credit cards, the seller deposits the credit card sales receipt just like it would if it was depositing a customer's check. The bank overnight increases the balance in the company's checking account, but the drawback is that there's a fee for it. Generally, it's a fee of anywhere from 1 to 5%. So you're getting your cash more quickly, you're eliminating your risk, but you do have to pay a fee for it. So you look at the cost-benefit analysis, weigh the advantages and disadvantages. Maybe that fee is worth it for the convenience. You're going to get more sales most likely, and you're going to get your cash more quickly without having to worry about bad debts. So maybe that, even if it's a 5% fee, that may very well be worth it. So on July 16th, 2007, Barton Company has a bank credit card sale of $500 to a customer. The bank charges a 2% processing fee, and they receive their cash immediately, pretty much overnight. So you would debit cash, and let's actually jump to the credit first. You credit sales for $500, that's the sale itself, but you're not going to debit cash for $500 because you're not receiving $500. There was a 2% fee that was taken out immediately, so you're basically getting 98%. 98% of $500 is $490. The other 10 goes to a credit card expense. And now here's the other option here. On July 16th, Barton Company has a bank credit card sale of $500 to a customer. The bank charges a processing fee of 2%. Barton remits the credit card sale to the credit card company and waits for payment that is received on July 28th. So this is a situation where they don't get their money immediately. This particular credit card company pays apparently twice a month. So what we're going to do here is we're going to debit not cash, because we're not getting cash right away. We're going to debit an accounts receivable, but it's for the credit card company. This is not for the individual customer. This is the credit card company or the bank. Again, it's the same percentage, so we're getting 98%, which means we're only getting $490. The other debit was to the credit card expense for $10, and then we have a credit for $500 to the sales. It's the same entry, it's just we're debiting accounts receivable for the credit card company. And then July 28th, we actually collect that accounts receivable, so we debit cash for that $490, we credit accounts receivable for that $490, we're good to go. So we've talked about setting up accounts receivables. That's the first step. Now, if you're in business, you realize that, again, some customers in the end just aren't going to pay. We have to estimate this. We have to account for this. It's a cost of doing business. Think about this. You're generating more revenue by offering these flexible payments. Because of that additional revenue, you're just likely to have a little bit more expense for these bad debts. The goal here is we want to match the two together in the same period. So let's talk about two different ways that you could potentially record these bad debts. Two different ways you can account for these bad debts. The one that seems the most obvious is called the direct write-off method. We're going to see that, and then we're going to talk about some allowance methods. So with the direct write-off method, we record the account like we normally would. We sold on account. Now we're hoping this customer pays. They may not. We wait until we find out that we're not going to be able to pay, or that they're not going to be able to pay, and that's when we write the account off. That's when we account for bad debt expense. It could be 30, 60, 90 days later before we write this off. So on August 4th, Barton Company, and this is going back to the earlier example. So now on August 4th, we determined we still can't collect $350 from Martin. Remember, they paid a portion of the account. They had some money left, and now we're finding they're not going to pay it. So under the direct write-off method, this is when we finally account for a bad debt expense. We debit bad debt expense for the amount that we think is no longer valid, and we credit accounts receivable for that same amount. Now on September 9th, about a little over a month later, they decided to pay a portion of that. So we wrote off $350, but now they're saying, you know what, we'll pay you $200. So what we have to do here is reverse the write-off entry, but only for the portion that they're now going to pay. So we wrote it off, we debited bad debt expense, we credited accounts receivable. Now we're going to reverse that. We're going to debit accounts receivable to put it back on the books, and we're going to credit bad debt expense to reduce it. Because we're finding out now it really was an expense, because it really wasn't an expense because now they've paid the money. So we're reversing the bad debt write-off entry. Keep that in mind as we go later on in the chapter and talk about some other methods. We'll have to reverse the write-off entry. They call it reinstating the account. So it's now back on the accounts receivable for that customer. And then immediately after, we go and pay it off because they actually did pay us the money. So we put it back on the books just so we can take it off in the right way, in a better way, with a payment. So we debit cash for $200, and now we credit accounts receivable to take it completely off the books in a good way. So you may question, on this same day, why would we put it back in the accounts receivable just to immediately remove it again? The answer is that we want to leave an audit trail. We want it to be very clear what happened. We reversed the write-off, and then we paid it off, or we had the customer pay it off. So we want to leave that trail, leave those steps in there, so anybody that's coming in to look at our books can tell exactly what happened. We don't want to try to merge these two entries together. So that was the direct write-off method. I mentioned that the big problem is that there may be a delay between the time when we record the credit sale and the time when we find out that particular customer is a bad debt, so we record expense. We mentioned how having credit sales generally increases our sales overall, gives customers more flexibility. They're more likely to come to us to buy their product. So with that increased revenue comes a little bit more expense. We're going to have some bad debt expense. We just have to expect some percentage of it. In a perfect world, everybody would always be able to pay, but we're not in a perfect world. So the goal here is to follow the matching principle. We want to record any expense that relates with a revenue in the same period. So again, I said these credit sales helped us to generate more revenue. So if they lead to an expense, which they will, bad debt expense, we want to try and match it in the same period as the revenue. The problem is if we wait until that particular customer goes to a bad debt, that may be 30, 60, 90 days later, sometimes even 120 days, which very well may be in the next fiscal year. So we recorded revenue in 1 year, and then we may not record the expense until another year. We violated the matching principle by doing that. We didn't match them in the same period. So that's what we're going to talk about with the allowance methods. We want to figure out the best way to match revenue and expense in the same period. Now, materiality, they're basically saying, yes, matching would be better, but let's take a look at the amounts. If they're so small, if we have so few accounts receivable customers and the bad debt expense is nearly non-existent, then we may say, you know what, we're not going to bother with this whole matching principle. We're not going to bother doing this allowance method because it really wouldn't make a difference one way or the other. The amounts are so small, the risk is so small that we're just not going to spend the time to do it. We can do that because of materiality. The materiality constraints say if the amount really won't have a big effect one way or the other, then we don't need to follow the other principle. But in most cases, you're going to find that the amounts are pretty big for a store of any sort, so we will want to match those. We do this matching by using an allowance method. What we're doing is, since we don't want to wait until we know exactly which customers will go bad, we estimate out of the total accounts receivable, what percent do we think they're going to go bad. We don't know which customers specifically, but we have a pretty good idea of what amount based on prior year history. So that's what we're doing here. There are two advantages, as it says. It records the estimated bad debt expense in the proper period. It matches them with the related sales. That's on the income statement. That's how our income statement is more accurate. And the balance sheet is more accurate because it reports the accounts receivable balance at the amount that we actually expect to receive. It's called the net realizable value, what we really think they're worth. People may owe us $100,000, but we really only expect to receive $98,000 just based on past history of uncollectible accounts. So at the end of its first year of operations, Barton Company estimates that 3,000 of the accounts receivables will prove uncollectible. We don't know which ones. We just have an idea that about 3,000 in total will be uncollectible. So the total accounts receivable balance at December 31st, 2007 is $278,000. But again, out of that, we really don't think we're going to get 3,000 of it. So they've given us the estimate. Our entry is going to be a debit to bad debt expense to recognize that bad debt expense in that period, and a credit not to anyone's accounts receivable because we don't know which customers will not pay. Instead, we're going to credit something called the allowance for doubtful accounts. I like to think of this as a cushion account or a fund account. It's something we're setting aside to handle future write-offs when they actually do become bad debts, when they do become uncollectible. So we're setting this fund up. By the way, this is known as a contra asset account. It offsets the accounts receivable. So we're saying, yes, we know we have this balance of accounts receivables, but we think 3,000 of that total is not going to be collectible. And on the balance sheet, you take accounts receivable less the allowance for doubtful accounts. That gives you the net realizable value of your accounts receivables, what you really expect to receive. So this is the entry. Again, we can't credit accounts receivable because to do so, we would have to know which particular customer won't pay. That's the only credit you can make. It has to be to a specific accounts receivable, and we can't do that. We don't know who. So we credit this allowance for doubtful accounts instead. So what happens here is our accounts receivable balance is still at the full 278, but now we have a credit balance in the allowance for doubtful accounts. The allowance is a contra asset account. Assets have a normal debit balance. A contra asset should have the opposite normal balance. That's why it has a credit balance. And this is how it shows up on the balance sheet. The one thing that's wrong here is there shouldn't really be a heading. The balance sheet doesn't have a debit or credit column. It's just your individual amounts and your subtotal. So you would have your whatever cash you had, which they don't even have an amount here. You'd have your accounts receivable for $278,000, less the allowance for doubtful accounts of $3,000. That gives you a overall balance, a subtotal of $275,000. That's the net realizable value. So in that entry, they actually gave us the estimated amount. They said $3,000. In reality, we would have to calculate that ourselves. We'd have to figure out what amount to use. So we're going to talk about a few methods. They say two methods because we have two main types of methods, percent of sales and then the various accounts receivable methods. Under the accounts receivable methods, however, we're going to find we have two different types of those. So really there's three methods we're looking at here. The percent of sales method is the easiest. we're basically saying, based on historical data, what percentage of our total sales were never collected. So we use whatever percentage we have from historical data. We take our current year sales multiplied by that percentage, that estimated bad debt percentage, and we get an estimated bad debt expense. So we know the revenues, those were the sales, and now we have our expense. As an example, Barton has credit sales of $1.4 million in 2007. Management estimates that 0.5% of credit sales will eventually prove uncollectible. What is the bad debt expense? We simply multiply the two things together. $1.4 million of accounts receivable, 0.5% bad debts. That tells us that we need to record $7,000 of bad debt expense to properly match things up. We debit bad debt expense, we credit the allowance for doubtful accounts. So the percent of sales method, what this calculation gives us is the entry. It gives us what our bad debt expense needs to be that period. And by the way, since we're crediting the allowance account, if we wanted to find out the new balance of the allowance account, we'd simply take our beginning balance and add in $7,000. That'll tell us what our ending balance in the allowance account actually is. But the percent of sales method directly gives us this entry, the $7,000 for this particular entry. The other method, it kind of works backwards, works a different way. The percentage of accounts receivable methods. So what we do here is we want to compute the estimate of the allowance for doubtful accounts. In other words, the desired balance in that allowance account. How much do we want to have set aside to handle possible write-offs for the current balance of accounts receivable? So to do this, we take the year-end accounts receivables and we multiply it by some bad debt percentage, again, based on historical data. Now that step number one, it's going to give us a dollar amount, but it's not giving us the entry like the other method did. Instead, it's just giving us what we want to end up with in the allowance for doubtful accounts. Remember this last method, I said the calculation directly gives us the entry, and then we could figure out what the new allowance balance is. Here, we're figuring out what the new allowance balance should be, and we're backing into what the entry needs to be to get us there. So to calculate what the bad debt expense needs to be that period, we take the estimated or desired adjusted balance in the allowance for doubtful accounts, what we calculated in step one. So this is what we want it to be. And we subtract out what it currently is. So maybe we want it to be 400. It's currently 300. That's the unadjusted balance before we make this adjusting entry. It was 400. We want it to be 400. It was 300. So our bad debt expense for that period needs to be 100. Because we need to add in $100 to get our balance up to 400 that we want it to be at. So Barton has $100,000 in accounts receivables and a $900 credit balance in allowance for doubtful accounts. Keep this in mind. It has a credit balance right now. The allowance is a contra asset, which should have a credit balance, so we're all good. It has a credit balance. That's where we want it to be. On December 31st, 2007. Past experience suggests that 4% of receivables are uncollectible ultimately, so we need to figure out of this $100,000, we need to figure out what allowance balance do we need to have to account for the fact that 4% of those 100,000 aren't going to be collectible. So the desired balance in the allowance for doubtful accounts is 100,000 times 4% gives us $4,000. We want to have $4,000 in that allowance for doubtful accounts because we don't think we're going to be able to collect that money. Now the key thing is that's where we want it to be, but remember it only had a $900 credit balance. We want it to be up to $4,000. To get it there, we have to add in $3,100 more dollars to get it to $4,000. Now the way we add in $3,100 is through this entry. a debit to bad debt expense for $3,100, a credit to the allowance account for $3,100, we're good to go. That was the simple percent of accounts receivable method. Now the other type of accounts receivable method is called the aging method. Here we don't just take the ending balance of accounts receivable, multiply it by 1%. Instead, we take a look, we break that balance of accounts receivable down into how far past due each debt is. So we group it into categories. We group it into ages. Or do we have some number, some dollar amount that's 30 days past due, some dollar amount that's 60 days past due, maybe some are 90 days past due? You can imagine the longer you go past due, the higher the risk is that you're never going to collect it. So you want to take that into consideration. So we group each receivable into categories based on the due date. We multiply each age group by its own estimated bad debt percentage, again based on historical data, and we get a dollar amount for each category. We add them together, and we get a total bad debt estimate. So this is a simple example of an aging schedule. Again, these categories can change from company to company, 1 to 30 days, 31 to 60, whatever they want to do. We take a look at the balance at each level. Notice that some of these aren't even past due yet. They're still putting them in here. There's a very low risk that we won't collect those. They're not even due yet, so we don't know for sure. 1%. But if you go down to this 90 days past due or over 90 days past due, there's a pretty big risk that we're never going to collect it. 60%. So we get these dollar amounts there, and we end up with a $5,320 total estimated uncollectible amount. So we wanted it to be $5,320. It's currently at $900. We need to add in $4,420 to get it there. And again, we do that through our normal entry. Debit to bad debt expense, credit to the allowance account for $4,420. So now we're talking about writing off a bad debt under these allowance methods. We already talked about writing off the bad debt under the direct write-off method. Now we're going to focus in on how we write one off when we're using these allowance methods. So we already said that we set up this fund, we debit bad debt expense, we set up this allowance account along the way, making estimates. But now when we find out that a particular account is not going to be uncollectible, the debit no longer goes to bad debt expense because we've already been estimating bad debt expense. Now the debit goes to the allowance for doubtful accounts. We're basically saying that we credited those allowance accounts, we set it up, and now we're going to use that fund up to account for this particular bad debt. So we're reducing the allowance with a debit. So we go back to that same Martin, $300 is uncollectible. We debit the allowance account for $300 to use it up to account for this bad debt, and we still do credit that particular customer's accounts receivable for $300 as well. Under that same example where we have a recovery of a bad debt, they decide later on, you know what, we'll go ahead and pay. We have to basically reverse the write-off entry and then account for the cash collection. So here they've said, we're going to pay that full $300. You wrote it off, but guess what? We'll pay. So there, remember the write-off entry was a debit to allowance, credit to accounts receivable. Now that they're paying, we're going to reverse it. We're going to debit accounts receivable to put it back on the books. We're going to credit the allowance account to basically put this money back in the fund so we can use it later on for some other account that does go past due. So we've put it back on the books on the accounts receivable. Immediately after, we're going to handle the payment. We're going to debit cash to accept the payment, credit the accounts receivable to show that they really no longer owe the money. So we're good to go here. Now we're going to talk about notes receivables. So a note is a little bit more formal than an accounts receivable. A note, by the way, it stands for promissory note. So this is where we have a formal promise to pay. They've signed a formal financial instrument. We have a specific date, and they're generally going to pay interest as well. It's a little bit longer term, so instead of just the 30 days that we normally give them for an accounts receivable, now we're going to give them maybe 90 days, 120 days. So what we would do here, this is an example of a notes receivable. We have all this information we need to see. We need to have the term of the debt, or term of the receivable in this case. So in 90 days, we're going to be able to accept this money. The payee shows who it's actually going to be paid to. Barton Company, that was us. We sold something to someone else. The maker, who is promising to pay this money, who is signing this? Julia Brown. That's the customer. The principal, that's the actual value that we're talking about. The interest rate, and generally it's a per year or per annum. So this is an APR. And then we calculate the actual due date. What is 90 days from July 10th? It's October 8th. Now, they gave us an annual interest rate, but as you know, that note wasn't for a year. So we need to figure out how to calculate the interest. Whoops. We take the principal of the note, which I believe was $1,000. We take it and multiply it by the annual interest rate because that's what's given to us. But we're not going to pay that full annual interest rate because we're only borrowing the money, or actually the customer is only borrowing the money for, in this case, 90 days. So annual interest rate times the percentage of the year that we're dealing with, that gives us the interest amount for that 90-day period. One thing I want to tell you here with the time expressed in years, there's something known as the banker's rule that is common in finance. And this basically says we're just going to level off the year at 360 days. We're not going to take the actual number of days in a year for these calculations. We're just going to multiply it, or we're going to pretend like a day is 360 days, or like a year is 360 days. The reason that's leveled off is because 360 works very well with 12 months. That's really the reason it's done. It makes for nice clean entries, nice clean calculations. So this is common not only in accounting but in finance in general. So on March 1st, 2007, Matrix purchased a copier for $12,000 from Office Supplies Incorporated. Matrix gave Office Supplies a 9% note due in 90 days in payment for the copier. What's the maturity date of the note? So they're just looking for the date. 90 days from March 1st. There are a couple of ways to calculate this. We'll go through this first one. We take the number of days in March. There are 31 days in that particular month, minus the date of the note, which was on the 1st. So that means we have 30 days left in March after that first day. That's 30 of our 90 days. There are 30 days in April. That takes us to 60 days. We still have plenty to go. We need 30 more to get to 90. So we use 30 days out of May. We know May has 31 days, but we're only going to use 30 of them to get us exactly to day 90. So the note is due and payable on May 30th, 2007. To calculate the interest, we plug it into that earlier equation where we have $12,000, that's the principal, times the annual interest rate of 9%, multiplied by the time expressed in years, the percentage of the year that we're dealing with. We know it's 90 days, and we're going to divide it by that 360-day banker's year to get us basically 90 out of 360, 1/4 of the year, 25% of the year. So 12,000 times 9% times 25%, that gives us $270 of interest. So what we're going to do here, on March 1st, we're going to record the actual note itself. We're going to debit notes receivable. It's still an asset for $12,000. We're going to credit the sales to reflect the fact that we did sell a product. And then on May 30th, we're going to collect that. But we're not just going to debit cash for $12,000 because we're collecting more than $12,000. We're collecting the $12,000 plus interest. As you can see here, it's $12,270, but let's talk about how we got that amount. We know we have to credit notes receivable for that $12,000 because we're pulling that off of the books. We have to remove that from the books. So that's a credit for $12,000. The interest revenue we just calculated was $270. That was the interest amount, and we're crediting it because it's revenue. So now we're going to record a dishonored note. So what we're saying here is that that customer, they signed a note, and then 90 days later on May 30th, they tell us that, you know what, sorry, we're not going to be able to pay the note. So you'd think, hey, that's a bad debt. But in reality, we don't immediately convert notes receivables to bad debts. Bad debts only come from accounts receivables. So what we basically do here is we set up an accounts receivable for this customer. It's going to be the full $12,270, and then we still credit our interest revenue for $270 because we did earn it, even though we're not going to collect it yet. And we credit the notes receivable for $12,000 to pull that off the books. We're basically moving this from a notes receivable to an accounts receivable. From that point, we go through our normal bad debt entries. Now this last slide just talks a little bit about disposing of receivables. So if we have a bunch of receivables, customers promising to pay us money, that's fine, but we may not be able to wait 30, 45, or 60 days to collect on them. Maybe we need cash right away to buy more inventory or whatever. So sometimes we want to convert those receivables to cash before the due date. There are plenty of financial agencies out there, banks and such, that will be glad to buy those accounts receivables from you. What that means is if you have a bunch of customers that owe you a total of $1 million, you can take those agreements to a bank and say, we need cash right now. They'll likely give you, let's just say $950,000. That maybe even on the high end. They'll give you $950,000, maybe $900,000 in return for that. So they're taking a fee out of that. That fee is basically due to the fact that they're now taking on the risk of collection of those accounts. And obviously financing, they have to wait 30, 60 days. So they're waiting now instead of you waiting. They're not going to give you that full amount. That wouldn't make sense. Why would they want to give you the amount and then have to wait for the cash themselves? So if you sell or factor receivables, you can get cash, but you're not going to get 100% of the cash. The other side of this is, since those receivables are an asset, you may be able to pledge them as collateral for a loan. So if you want to go borrow money, say, you know what, I need to borrow money, I'll pay you your interest, but as collateral, here are these agreements. So if for some reason I fail to pay you, you have the right to collect these accounts on my behalf. And that takes us to the end of this chapter. Hopefully this has helped to flesh out some of the topics in accounts receivables and bad debts. But if you continue to have any questions on this, please feel free to let me know, and I'm here to help. So I thank you for your time, and I will talk to you in the next session.